Hey everybody, it's me, Kaylee McMahon. You already know me from the Apartment Queen, and today I have a very special guest. We're going to be talking a little bit about real estate versus the stock market. So how does the cash flow from both of those work? Kim, would you please introduce yourself? I won't do it justice.
I'm sure. Kim Radiker Bays. Have purchased over 7,600 apartment units in the DFW area over the past 11, almost 12 years now, and have really enjoyed that whole process. So started kind of with a smaller property and then just kind of built from there, and started with 2 team members and have now grown it to about 170 to 180, give or take the day and what's going on. So
holy Hannah, that's very impressive. So what we're going to talk about today, and so there's going to be kind of like 2 sides, obviously real estate and stocks. I'm not the expert when it comes to talking about the stock market. I was never involved in it before getting into real estate. So the most I understand is just kind of watching what the general patterns are and being aware of, okay, are we excited about healthcare this month? Or we, you know what I mean? Like kind of following the trends to see what's over historical trends lasted or done well for a long time, because it kind of translates a little bit to multifamily. For example, healthcare being something that's pretty steady. So we have tenants that are, in the medical profession. That's great. So that's the only way I understand it. Kim, would you tell our audience a little bit about your experience with the stock market and educate us a little bit?
Sure. So I've certainly had some experience with the stock market for a long, long time. I guess probably more so in the past few years than really previous to my real estate career. Definitely had money in 401ks and that sort of thing prior to starting in real estate, but kind of liquidated that in order to start the real estate program that I have followed. So that I've kind of gotten into and built the company that I've built. So a lot of the prior stock market stuff went into that. So for a couple of years, I didn't really have much of anything in the stock market. And then now that we're a little bit further along into the business growing, the biggest thing is that as key principles on the apartment notes, you have to have a good amount of liquidity in addition to net worth in order to qualify for the loans on the multifamily properties. So one of the hardest things to find is not really the people that can sign on the loans with you that have net worth, but more so the people that actually are willing to maintain liquidity, because a lot of the people that want to invest want to invest a lot of their net worth in various real estate transactions, which are all rather illiquid. So, I guess under due protest, I have had a decent amount of money invested in more liquid assets over the past few years than I have before. And it was a difficult transition, kind of starting with that kind of when we got the first larger distribution from a sale and starting to put some of that into the stock market. And I'm like, oh my gosh, I worked really, really hard for this. I don't want to just lose it. Obviously, the stock market is something you have a lot less control over than real estate. That doesn't mean it can't be very, very lucrative. It just really depends on what you are trying to do with it and how much time you put into educating yourself on the various positions, on the various stocks, on different systems that you can use, selecting a broker. Obviously, there's fees anytime you have a broker or investment manager for you, but that's true, again, as a passive investor in real estate as well. So I think the market fluctuations in the stock market are definitely a bit more extreme often, or a little bit faster moving than they are in the real estate market. So that's one thing to keep in mind. I think the biggest thing that I've really learned about investing in stocks, bonds, anything that's kind of the liquid investments, is that you have to figure out what system you're going to use and then just make sure that you follow the system. The number one way to lose money in the stock market is to buy something and then, panic when it's down a little bit and sell it, and then you end up buying back when it's higher. So you really have to have a steady hand, figure out a system that you're going to use, either turn it over to somebody else, which is never something that I've been hugely comfortable with, but I do have some great experts and fund advisors that have done a great job for me now. But that's one of the big things, is just really making sure that you have that system in place, that whatever system it is that you're dedicating that portion of your portfolio to, that you're going to follow that. So you're not, because something is the new hot trend, you don't want to buy that now necessarily if it's not part of your overall strategy. So really sticking to whatever the rules are that you've met. One of the big things with the stock market is that if you miss the top few days of a rally, of like an entire bull market, honestly, your returns can be less than half of what the total market returns. So While it would be fantastic to be able to miss those, worst few days and time it just exactly right, barring a crystal ball, it's incredibly difficult to truly time the market. So you want to pay attention to good companies. One of the things that I've definitely been working on, I do some covered call strategies, which are an interesting cash flow strategy that actually kind of pays you for the basket of stocks that you're owning. And so that's been one thing that I've worked on that's probably a little more akin to real estate investing.
Yeah.
Only generally speaking, not with as much upside then. So you are, so you buy stocks and then sell a call against them. And so if the price gets up to that point, the stock will get called away. So you'll get a small capital gain from that, but you get the income premium or the option premium as your income in the meantime. So it's a good cash flow strategy, but not much of an appreciation one. So there's been certain times when I'll buy a stock and then it goes up $10 in 1 month and the call that I sold was $2 more. And I'm like, man, I really wish I would have had those $8 per share back. So, so that's kind of a strategy. There's also different growth perspectives and different things. So some of the strategies that I've learned about have been very much looking into the actual health of the company itself and kind of what, based on the free cash flow that it provides, but also there's been certain times certain investors have managed to find, or certain advisors have managed to find stocks where the cash on the balance sheet, actual cash in the bank on this company is actually less than the market capitalization at that point in time. So really, whether the company is doing well or not, they have enough cash to make it worth more than that anyway. So that's an interesting piece unto itself. But all that being said, you have no control over the stock market, which is why I don't like it quite as much. And you don't, even the people that you trust and that do an awful lot of fantastic research and amazing systems and different things, they don't have any control over the stock market either. So that's why, given the choice, I'd probably just have more and more invested in real estate projects. Obviously, the real estate projects that I do are things that I can kind of control, which is, as a bit of a control freak, is probably a good fit for me. But also for the passive investors, they know me and they're able to hand over the controls of that investment to me and know that, even while they're not losing sleep over it at night, that I will if necessary. So not too often, hopefully, but I will when necessary. So, both the stock market and the real estate market are relatively forgiving over time. But again, when you're timing the stock market, hitting those few bad days and missing out on the few up days can really make a huge, huge difference in your overall return. Whereas real estate can be a very forgiving investment. It's over time, just based on inflation primarily, but also other market factors. Oftentimes the prices will go up over time. So really time will cure most things as long as you're really careful with certain pieces of your real estate investment. So, a really important piece of that is making sure, first of all, that you buy right to whatever extent you can, but the financing is absolutely key. If you have financing that requires you to dispose of an asset, sell an asset, refinance an asset at a really undesirable time, that can definitely be something that will actually hurt and create a real situation that you have to deal with, as opposed to just waiting for things to kind of grow out of it. So one of the strategies that I've always pursued is to try to maintain as much exit flexibility as I can. So that's not always the longest term loan at the lowest interest rate, which many people might think that would be the best strategy. But if your plan is to hold the asset for 3 to 5 years and you put a 10 or 12 year loan on it, whoever you sell to either has to assume that loan, or there can be a prepayment penalty that at times I've seen into the multiple millions of dollars. And it is really, really hard to have executed a business plan very effectively on a piece of property, only to have Fannie Mae or Freddie Mac take half of your gains as a fee for not planning the timing out correctly. So one of the things I always try to do is kind of target some exit flexibility. So sometimes we've been able to, get loans that, for example, have no prepayment penalty after a year or two, but have a fixed rate that lasts for maybe 5 years. So you have a nice long window of 3 years. And at any point during that 3 years, you can judge what's going on in the market, judge what's going on with the asset, and make a an informed decision about when to sell or refi, whereas some of those longer term loans oftentimes only have like a 3-month window at the very end, unless you pay additional interest or additional fees along the way to get out. So even though it's a very long time in the future, it is a very specific window within to lend. So
now, Kim, you mentioned a term when I was listening to you, capital gains. Can you explain to me, I think if I understand correctly, that there are capital gains in both real estate and, like you mentioned, in the stock market, but how does that work with the capital gains taxes? How does that work with going into a larger asset later? Is it the same thing or are they different?
They're definitely mostly the same, but a little bit different. So capital gains taxation applies to both types of assets. Usually you have to hold whatever position it is for at least a year prior to selling. And it has to be held for investment purposes in order to get those reduced tax rates. So at least at the moment, until I'm sure a lot will change in Congress in the not too distant future, unfortunately. But at least at the moment, capital gains for most individuals are taxed at about a 15% rate, and sometimes up to 20% or 20% plus the Medicare premiums for capital gains that on individuals that have income that's a lot higher than a certain limit.
Really?
So both of those strategies, both the stocks and the real estate definitely qualify for the capital gains treatment on assets that are held long enough.
Yeah.
But there is, at least at this point, still 1031, which allows you to defer your capital gains on real estate when you sell. If you sell one piece of property and immediately reinvest all of the proceeds into a different piece of similar property, you can oftentimes defer those gains when you meet certain rules surrounding that. And whereas in the stock market, if you sell one stock for a big gain and then immediately invest in another stock, it's still just a taxable gain at the time that it's.
That's what I was going to ask, really. Mm-hmm. Now, can you crisscross either one into the other? Like, for example, if you have a gain in, you can't go to real estate.
It has to be like kind.
Like kind.
So.
Okay. Even if it's like
not that I'm a tax professional, but it has to be like kind.
Okay.
So.
Okay. Got it. Yeah, man. I'm curious that, when or if the exchange rules change in either or both industries, how that's going to affect, people going from one to the other, Like right now, a lot of people are moving towards real estate, because of their liquidity that they have, that they've been kind of saving up for a couple of other reasons. But, I'm just kind of curious to see what would force, people to go one way or the other. What do you think?
I mean, it really just depends on your expectations for kind of what's going to happen. I think at least personal expectations is that there's going to be a decent bit of inflation going forward. At some point, the money printing has to catch up to us on some level. And so I think there's going to be a piece of that plays. Now, real estate is a great inflation hedge, but even the stock market itself, as long as the inflation doesn't crumble the economy as a whole and expectations of future corporate earnings might be just as good a place as well. I mean, so sometimes, it is just things do go up when inflation exists. One of the nice things about multifamily real estate, which is what I specialize in, is that the leases are generally a year or less. So sort of in the 6 to 15 months is probably the majority of the leases in multifamily. So that does allow you to readjust rents annually or even potentially more frequently whenever the lease is up, to accommodate for market changes that could be driven by inflation. Whereas a lot of the time the leases on warehouses and other such things are locked in usually for 5-year, 7-year, sometimes even 10-year terms in terms of predisposed increases on an annual basis instead of actually paying market on each year. So there can be big advantages to that as well in a down market, but in a time when things are increasing, I think there is some advantage on the multifamily side.
Now, when you're looking at, that's great that I was going to ask, what do you think, kind of weighing one versus the other? But sometimes you have passive investors kind of in either situation or limited partners. And either way, it sounds like that person wouldn't really have control over how this asset goes. It's really just kind of knowing, like you said, the person that's behind the steering wheel well enough to go, okay, this is a better thing for me. But whenever you're having someone, for example, come over that might be watching this that has more experience with the real estate market, with the stock market, and they're interested in real estate, a lot of the times the question that I really get a lot of focus on is what is the internal rate of return? That's really like the biggest thing that they ask. And so some other things that matter more to some other people, like cash on cash return, or what is the equity multiple on exit? I mean, that language of moving from, say, stocks to real estate, how would you make someone feel more comfortable? Because a lot of people are like, I know stocks, I stick with stocks, and that's where I'm going to stay. How can you kind of bring someone over to the real estate side?
Well, I think the biggest thing is it is just a tangible asset. So that is, that's probably a big piece that I would say, like you actually own a piece of real estate. You can go and visit this piece of real estate. You can see the operations of the business. You can see that there are actually cars in the parking lot, if you will. So there is a certain amount of knowing what it is and having actual kind of financials to count on. The stock market is at relatively historically high levels in terms of PE multiples and those sorts of things at this point in time. So there's a market force that's kind of at work in a lot of that. And so the stock market doesn't always move with the economy, as we've very much seen the past year. It always is trying to forecast what's happening next. And so you are a little more subject to whatever the forecasts happen to be of a whole lot of other people that are investing alongside of you. And so there's a little less control in terms of that, a little less tangibility of that. And if you end up in a position, so I guess one important thing to remember regardless is while stocks are very, very liquid, so that is an advantage over real estate in some ways. You can sell them any day that you want to. At the same time, they can fluctuate pretty dramatically, especially in certain sectors, in certain areas, certain stocks. So that's an important thing to keep in mind as well, is that even though, yes, they are very liquid and you could sell them tomorrow, you may not want to if there's just recently been a 20% correction or that sort of a thing. Oftentimes you'd want to try to sift through that. So keeping adequate money to cover all of your basic expenses when you're investing in real estate or the stock market is a really good idea. At the same time, like I said, I'm a little cautious about inflation at the moment. So hoarding lots and lots of cash is not quite where my head's at either. So
a good balance, it sounds like. I guess my last question would be, whenever I'm looking at real estate, for example, a lot of the times when you're looking at a new market, just an investment by itself, you want to understand a lot of the history behind the town, the historical data basically on this investment that you're looking at. So is it the same thing when you're looking at stock market investments or the company's history or their performance? You go look at, that company's performance, but like, for example, the industry, well, just stocks in general. Let me just ask it this way. Historically, real estate tends to always appreciate over time. Like you said, it's very forgiving. It might dip down, dip up, but over time you're going, okay, there is appreciation for the most part. Now in the stock market, historically, what percentage of the time or how often does the projection that you're getting in the stock market actually overperform?
Well, and it definitely overperforms and underperforms. I mean, that's very true. Like I said, with real estate, you're going to hold it sort of until it's an optimal time to sell. At least if you haven't over leveraged yourself or gotten into a position where you are in a bad place where you have to sell, as long as you have sufficient value and sufficient cash to cover any shortfalls in operations, as long as your loan terms are good, all of those sorts of things, you're going to kind of wait until the right time to sell. And I think, obviously you can do that as well in the stock market, but it is much more challenging when you can just hit the I'm kind of scared and sell now button on a stock. So that's definitely a difference between real estate. So I guess the good thing about real estate is it's not very liquid, and the bad thing about real estate is it's not very liquid. So it kind of keeps you in the deal until it really makes sense to sell. I guess really overall, the trend of the stock market is upwards as well. What the market was, back when I was in college and, years and years ago is much, much lower than it is now. So stocks appreciate over time as well. There are a lot more short-term fluctuations. And I think a lot of it is that they're much more visible. I think they're also more distinct, but they're also more visible. So whereas real estate, like I said, it's only going to trade sort of at the optimal times unless various things. So there's certain recessions that actually take major hits to occupancy. Even COVID, really in different areas of the country were impacted substantially differently. I mean, so this is a unique time because the suburban assets way outperformed the urban assets. The Texas and Midwest, middle states and more rural areas dramatically outperformed. I mean, San Francisco saw a 30% rent drop along with 30% vacancy.
Oh my God.
First time in. So there's a reason I don't invest in California. Yep. Texas just feels a lot safer to me. So, I guess in real estate, it really is more about following the macro trends, but also understanding that just like, San Francisco had been a fantastic market for many, many years, even though it's got a lot of things about that market that scare me in terms of political controls and other things. It had been a great market. So there's always a chance for a black swan event, either in the stock market or not, or in real estate. So those pieces of it are very, very similar.
So it sounds like you've done a good job of being smart and having diversification, variety. So like you mentioned, I mean, COVID was nuts. It affected oil. It wasn't COVID that did that, but just at the same time, oil was affected. Real estate was affected. Restaurants were affected. Like a friend of mine is invested in a whole bunch of different things. And he's like, I can't get a break. Like literally everything was affected. So I think, having a hedge of sorts by being diversified is something you've done very well.
Thank you.
Well, Kim, so if any of our listeners are curious about getting in touch with you, investing with you, finding out more about what you offer, how can they get a hold of you?
Sure. The company that I run is Exponential Property Group. And so you can email for more information at invest@exppg.com. Or go to the website at www.exppg.com. Feel free to look me up. Again, Kim Radiker Bays. So I'm on LinkedIn. And so feel free to look me up there and send any messages there that you'd like to as well.
Perfect. Thank you so much for spending time to educate our listeners and viewers. Again, we'll see everybody on here next week. #1 Leading Ladies and on our She Best staff. Thank you so much.